Hello, this is the walkthrough for our second project, the portfolio optimization project. So this project is going to be a bit more hands-on than our previous projects have been. For the most part, those were a bit more mundane, just kind of getting stuff set up. Now we're actually going to kind of put Excel through its paces a little bit and actually do something. So first thing, just kind of the things that I've got around or that you may need. So there's the portfolio optimization assignment. So that one's on the ELC under the Market Watch tab. So going from there, I've got my Market Watch assignment. So in particular, I'm going to be using the Index tab and my Portfolio Optimization tab, which is just a blank tab. So you may also refer to your trading activity, your tracking. I'm just going to use the index. That way you it kind of minimizes the flipping back and forth. So we'll need those. We'll also need Google at some point. So I'm just going to Google that in a kind of blank tab here when we get to that point. And then the final thing is the closing price helper, or the copy of closing price helper that I have here. So so under the Market Watch tab, there is a Google sheet that I have a link for you to make a copy of. It'll really come in handy to cut down on the work for this project. You're not required to use it, but I think it'll make things a little bit easier on you. So that's what I'm going to use here. So the first thing that we're going to do for this project is that we need to get data on 20 stocks, or 20 securities. They don't necessarily have to be stocks. So the big thing is we need it for 3 years. So you need to make sure that you have something you can actually get data on for a 3-year period. So something newer you can't really use for this. You'll have to use something else. For my purposes, the stocks in my index have all been around that long. There's no real issue there. But some of you may have had a newer stock, a newer fund in there that may not have data for 3 years. Just substitute for another stock that you've traded, and you'll be good to go. So you're welcome to use stocks that are in your index, stocks that have been in your portfolio, are in your portfolio. I want them to be stocks that you've dealt with. So that way it's a little more useful to you. So the first part is going to be a little more mundane, and then we'll kind of get more interesting once we get into it. So the first thing is I need data, and so for that we're going to use the Excel sheet and the Google sheet. So I just want to take these ticker symbols and get data out. So certainly what I could do is just type those in. So go into my closing price helper. Whenever you use that, there's going to be a box for 5 ticker symbols, and so you can enter in 5 at a time. The reason I only had 5 set up is because Google Sheets sometimes can get a little bit quirky, a little laggy if you use too many formulas. It doesn't seem to be quite as stable, especially if you're looking at trying to do 20 different formulas for that amount of time. One thing is, because we're looking at longer periods of time, we want to go to historical data. So there's 2 tabs. The tab that you'll open it up on is current data. That one's set up to just give you the closing prices since the beginning of the semester. What you're actually going to want is historical data. That one's going to be set up to give you 3 years of data. They look pretty well identical. Just make sure you're on the right tab here at the bottom. So going from there, then I'm going to then just enter in the ticker symbols and off we go. So I'll bring this up. So Apple, Disney, Dish Network, Google, Johnson & Johnson. And so it'll bring each of those up. Each of them has 2 columns, the date and then the closing price. So for the first one, I'm actually going to select both the date and the closing price. That way I'll have the date for the rest of them. So I'll copy that, bring it over here, and just paste it in. Now I'm going to paste special here, and I'll talk about all the shortcuts and whatnot as we go through here. You don't have to. I don't really care about the formatting for yours as much. Just for mine, to make it look a little nicer here, I'm going to format things some. This is actually a date time, so it's got the date and the closing time. I'm just going to shorten that, so it just has the date showing to make it a little nicer to look at. And then so this was our Apple close. So that's my first one, and again, so that's all I need is just those closing prices for that period of time. Now, as far as what's going on here, so whenever I do this, so going forward, I'm just going to want the closing prices. So I can click there, and then I want to select that entire column. Now, Excel's got some pretty nice shortcuts. So, for instance, if you click Control, or if you hold Control or Command for a Mac, and then use the arrow keys, you can jump around to the end or the beginning of a row or column. More useful for us right now, if you hold Shift and use the arrow keys, then you can highlight more than one thing. So you can see me kind of highlight different things here. So if you combine both of those, then say Control, Shift, and down, that's going to take me all the way to the bottom. So then I can copy it. So you can either right-click and say copy, or what I was using is Command and C or Control C for Windows to copy, and then I can paste it over here, which would be Command V or Control V for Windows, or for my case I'm going to do paste special, which is Control Command V for a Mac. You can also use the paste ribbon, so that'll give you the option there normally to do that. But so I can get kind of all this data in one go and in pretty quickly, rather than having to go and download a spreadsheet individually and paste each of those in like you might have to do from Yahoo Finance or something. So a bit of switching back and forth here for a second, but eventually I'll get this in. And so certainly I could just do this for all 20, right? So I could just select them kind of one at a time and take those. And that's perfectly fine. And again, I don't necessarily care about the formatting for yours, so if you prefer to just kind of put it in as it was formatted before, that's fine as well. Alternatively, say that I wanted to get in the ticker symbol a little bit faster. I could select 5 of these and just say paste them over here. So instead of typing them in, I can just paste them in. Because especially you don't care about the formatting here, because you made a copy of this. It's yours at this point. So that would let me type those in a little bit faster. But on top of that, let's say that I wanted to do this a little faster. Well, I could select the whole thing. Right? So Control Shift right arrow and then Control Shift down for Windows, or Command Shift right arrow, Command Shift down for Mac. Right? I select all that, Control C to copy it, or Command C to copy it, and then I can paste it in. Now that gives me the dates as well, right? So I didn't necessarily want those, so I can delete those out. So I could highlight those columns. So if you click on the letter of a column, that'll highlight the entire column. And then if I hold Command and click each additional date column, or again Control for Windows, then I have all 4 of those highlighted. I could go right click and say delete, and then it just leaves the values that I wanted. So my ticker symbols here were Lowe's, McDonald's, Microsoft, Visa, and Verizon. So I've got those in. Even going from there, say that I wanted to, paste these over a little bit quicker. I could go paste special transpose and paste them sideways. So again, I can go to that paste bar and it'll give me more options. Alternatively, I could have done the paste special menu and click transpose. Right, so either way gets me there. But now I've got those done. Again, some formatting issues there, but relatively minor. But so now I've got those tickers in. I just need the data for them. Oh. Sorry about that. So if I just select 5 more tickers here, I can paste those over. And again, so I'll just select this all in a big block. Paste it over. Now, it gets a little bit trickier here. So notice that I still I have the tickers up there, which is a bit unfortunate. But if you have command selected, then you can click even something that's not connected to where you were right now. So then I can still kind of highlight each of these individually. So command and click on the next one, then command shift down, and then command click on the next one, command shift down. Then I can delete those, and it all works out. Right? It's a little uglier than before, but it still works. And so that's kind of the nice thing is that we can kind of speed things up a little bit. That way, because otherwise this data portion can get a little tedious, right? But ultimately, again, the important part to realize, right, is that either way I'm getting the data, right? So whether you got it from Yahoo Finance, whether you're using this at all, or whether you're doing this, right, you're still getting it. You're still working through it, right? So even if I'm doing one column at a time here, right, that still works. And arguably is a little bit cleaner, a little bit easier to deal with. So whatever way works. And so then again, I could do multiple at a time here. And so ultimately, all of that taken together gives me this big streak of data here, right? So I have all these prices now, and so I've got prices on 20 companies over 3 years. So from September 5th, 2014, all the way up to September 8th, 2017. Right? So I've got a 3-year period covered, and since I'm using weekly, you're never going to get it exactly 3 years, but so I've got 3 years and 3 or 4 days. So now, the good news is we're actually done with Closing Price Helper here. So that's really all we needed with it. I've got my data, so its job's done. Now going from here, the first thing we're going to want to do is to convert this actually over into returns. So if you look at the prices here, the prices are kind of all over the place, right? So you have hundreds, you have 800s, you have 80s, 60s. 40s. So you want to convert to returns so that all of those differences, all those kind of scale differences cancel out or wipe each other out. So I'm going to copy and paste these, the dates and the ticker symbols down here. And so that way I know what I'm looking at. Now if I zoom in, right, so now I've got those. Now the first thing is I want to do the returns. Well, remember, so returns, we need 2 closes. So we need the previous close and the current close. Right, so return being new minus old divided by old. So, well, if I look at this, that means if starting from here, I couldn't do a return for the 5th. Right? The first return I could do would be for the 12th, because then I have a closing price for the 12th and for the previous week. So the 5th, I'm going to have nothing. So if I come down here to my returns that I've set up, basically the 5th, I don't need that, right? So I'm going to highlight that row, so click on 163 here and hit delete. Right, so I'm not going to have anything for that, so I'll just take it out of my table here. Now for the returns, I'm going to set the returns up. The good news is I only really have to do this once. So I'm going to say the new return, so for the 12th, the new return minus the old return over the old return. Now remember, when you do this, you need to make sure you have parentheses in the appropriate spots. So new minus old needs to be in parentheses, and then divide by old. So I'll hit enter here, and it'll give me a decimal. So that's the return for September 12th, 2014 for Apple. It doesn't matter that it's in decimal form. Excel's going to treat everything as decimals. All that matters for is what we look at it as, right? So whether it's 0.027 or whether it's 3 or 2.7%, it's the same thing. Now from here, I want to convert, or I want to go ahead and fill in this whole table. And so here I get to use something else. So normally in Excel, your cursor's this little fat white cross. So if we go to the bottom right corner of the cell, though, it turns into a skinnier black cross. That's a little more apparent on Windows than it is on a Mac. But in any event, we see that happen here. So then I can drag it either straight down or straight over. And so what that's going to do is then to copy that formula across. So say I go over here. Excel tends to be a little worse about going over, so I tend to do that first. But now we can see that it updated that formula for each column. So GE here is in the T column, so it did T3 minus T2 instead of B3 minus B2 over there. Right, and so that's true of all these. So now if I highlighted those again, so there I just clicked and held and highlighted them. Then I come back over and I have this black cross. Well, because of the fact that I have these dates set up, so because of the fact that I have this column of data already, Excel knows then that I may want to fill in this whole thing. So if I go here and I double click, then it'll fill in this whole table. So then you can see so the first one, T3 minus T2, jump down here, so I've got T14 minus T13, over in a different column, R9 minus R8, so all those are updated appropriately. Right? So it just calculated those, couple thousand returns for me really quickly. And so cut down our work tremendously there versus us having to do that ourselves, or copy and paste it in a few thousand times. So we have our returns in, and so now we can go from here. We can start kind of putting pieces together. So whenever we do this, we want to first thing kind of set up our calculations. So you want to set up the portfolio calculations so that then we can go back and use those to optimize. Right? So you can't optimize kind of straight away. You need to get a baseline set up, and then we can optimize from there. So in particular, we want to get the average, the portfolio return, the portfolio standard deviation, and the portfolio Sharpe ratio set up. Right? So once we have those, then we can look at actually optimizing. We can look at actually forming an efficient portfolio or an optimal portfolio. And so, well, so basically, we're going to take what we've done in Chapter 6, or what we're doing in Chapter 6, and look at putting that into Excel. Well, so the portfolio return is just the weighted average of the individual stocks. So the first thing we're going to need is the average return of those stocks. Right? So I'm going to take the ticker symbols, paste them down here, and say our average return. Well, then I just want to do the average function. So I want to take an average of all the returns for Apple. Well, the good news is that Excel makes that pretty easy because there is, in fact, an average function. So average, and then I just need to select all the returns in that column. So I can click on the bottom one there and then do Command-Shift-Up, well, that'll bring me all the way up to the top, which includes the ticker symbol. I don't want to include the ticker symbol, so if I just do shift down, then that'll leave me at the first return. Close my parentheses. Then I have this entire column selected. So if I come down here, then our average of all those returns, and I can hit enter, and it gives me the average for Apple over that three-year period. So I've got that average return done. Now I'd like to do that for all of them. Well, again, Excel doesn't always recognize if you want to go sideways. It's really good at vertical, but not always horizontal. So in this case, double clicking won't work. I'm going to have to drag it. But if I drag it across here, then now I've got my average return for each of these stocks. So each of these is the average of its column. And so, we kind of boiled all those hundreds of numbers down into just one for each of them. And so for average, so for our portfolio return, that's really the big chunk that we needed. But since we need kind of all these numbers, then let's go ahead and set up the other pieces we need, and then we'll come back to the actual return calculation. So the next thing that we have to get is the portfolio's standard deviation. Well, there we need a few things. So we need not only the individual variances of the stocks, we also need their covariances. And so we represent that, or we solve for those in our covariance matrix. So we're actually going to create that covariance matrix. So that's how Excel is going to understand those values. That's how we're going to put them in. So I'm going to put my ticker symbols in, and I'm going to put them in both horizontal and vertical, because that covariance matrix, again, is going to represent the covariance of whatever. So each of these values is going to represent the covariance of whatever is on the left-hand side with whatever's above it. Right? So that cell D330 here would be the covariance of Lowe's with Dish Network. Right? And so the good news is that we've thus far we've kind of worked through calculating all this stuff individually. Now we're actually going to use matrices in order to have Excel calculate all of these for us. So if you think about 20 stocks, so each of the 20 stocks has a covariance with the 20 stocks in there. That's 400 values. Right. So certainly we could go through and do the covariance of Apple with Apple, the covariance of Apple with Dish, the covariance of Apple with Google, etc. But that's going to take forever. Right. So instead, we're going to use matrices to do it much quicker. Now here, I do want to note that you will not get credit for this unless you use functions in Excel to do this. So you need to either follow along with me or hoof it by hand the primitive way. I don't want you to use any other add-ins that you may have gotten from an internship or anything to do this. The reason being that there are a lot of wonderful things out there. There are a lot of really good add-ins for Excel, but for the most part, the good ones cost money, and they're updated relatively frequently. So there's a good possibility that the add-in that maybe you're relying on right now may break in the future, and since you're not working at whatever company your internship was at, you may not be able to get the update without paying hundreds, maybe in thousands of dollars. So it's much better to be able to do this on your own, right? To be able to do this with just what's built into Excel, and so that's why I'm going to be kind of a stickler on this point. Okay, so with that out of the way, what we want to do is we want to take these returns, subtract out the average returns. Right? So just like whenever we do this by hand, we want to take the average squared deviation. Well, so the easiest way for Excel to understand that is to make two matrices multiplied together. So in particular, we're going to say then I want to take all of those returns. So I'll select all the returns for Apple, then I'll go over for everybody else. So I'll take all of those returns. So I've got that entire big table selected, minus the dates. So I don't want the dates, I don't want the ticker symbols. And then I'll say minus the average returns. All right, so just select those and then Command Shift right to select the rest of them. And that's going to be my first matrix. The second one is going to be exactly the same, so I'm just going to copy and paste it. Alternatively, certainly you could select it again, but I'll just copy and paste it here for simplicity. Well, this is going to cause a problem. Right? So that's what we want to do, but it's going to cause an error because those matrices aren't lined up correctly. Right? So out of this, we want to get a 20 by 20. Well, that means the first one needs to be 20 rows, the last one needs to be 20 columns, but instead we're going to have 140 rows by 20 columns for both of them. So what we're going to want to do is to transpose the first one. So transpose just means that we're going to flip it on its side. So the ones that were rows are now columns, the ones that were columns are now rows, and that way we get it facing the right way. Well, the good news is that there's a transpose function in Excel, so we're just going to take that first one and put it inside a transpose function. So we're going to transpose the returns minus the average returns. Then we're going to multiply them by, again, the same thing, not transposed. And that way we have a 20 by 20 comes out of it. Now, the other thing we need to do, so we're not done, unfortunately, we have to divide by the total number of observations minus 1. Right, so we need to take however many dates we had here, essentially, minus 1. So certainly, if you're kind of astute or paying attention, you may have counted how many returns we had for Apple, or how many returns we had for any given company. If not, or say that we were dealing with a much larger set of data, you may not be able to count it, or may not be able to notice it as well. So instead we can do the count function. So just count, and then I'm just going to select the returns for Apple here. Right, so any just one column, I'm just going to select them all. Again, I don't want the ticker symbols, so I'll go Shift down once I've selected the column there. And so that'll tell me how many numbers are in that row, or how many values are in that row, or excuse me, in that column, and that way I'll know how many observations I had for each company, because I have the same number for each company here. And so then the last thing is, because it's a sample, I want to subtract 1. Right? And so we'll put parentheses around that, so you want to make sure that you're dividing by the count minus 1. You don't want to divide by the count and then subtract 1 from the end. But so at this point we're done. So at this point we have our MALT, we have our transposed returns minus the average returns, we have our average returns, we divide by the count minus 1, we hit enter, and we're going to get an error. So we get an error out of that. The good news is that's what should happen. So because of the fact that we use the MALT function and we use the transpose function, those are what are called array functions in Excel. So basically they work with matrices, or for computer science, arrays. And so because of the fact that they're working on a large number of cells, or because of the fact that they may have multiple outputs, Excel basically wants to make sure that you know what you're doing. So Excel is going to want you to basically confirm that you're doing or that you understand what's going to happen, or that you know that it's going to change these cells. So if you just enter it like a normal formula and hit enter, then you get an error, specifically this value error. So that's fine. What we're going to do then is to enter it in, without the to fix that in a second. Now, this seems like kind of an extra step here, and it is. If you look this up, Microsoft's going to tell you to do this, or tell you to use this function in kind of one big, huge step. And I think that's a mistake, because if you happen to make a mistake here, so you happen to put your parentheses in the wrong spot, or you happen to put your comma in the wrong spot, then you're going to get an error and it's going to clear your formula out. Whereas now, yes, we got an error here, but it wasn't one of the really kind of fatal errors. It was just a value error here. So now our formula is in there, right? It didn't like it, but it's in there. Whereas say that I had left a parenthesis off, right, then you get one of these sorts of errors. In this case, it asked if I wanted to fix it, but sometimes it just gives you an error and then clears it out, right? I'll undo that and go back to the correct way. So point being that this can save you some headache, especially if you're less than sure that you entered things in properly, so you don't have to worry about having to re-enter it in. Okay, with all that said, so now we're ready to actually enter it in and get our answers out. So, so I kind of zoomed out here so we can see it all. So now you want to click on that cell. So we left it in the top right corner here. So we have the Apple cell here. So I want to click that, and I want to highlight the entire 20 by 20 area. Right. So there I clicked and dragged. Alternatively, you could click and then use the keyboard shortcuts. Right, so shift and to the right, shift and down. So either way, we get this 20 by 20 area selected. Once we have that, then now we're going to go back. So notice your formula is still in the formula bar here. I want you to click back in the formula bar. And then, like I said, we're going to tell Excel that we understand that we want it to do this. So we're going to say Shift Command Enter, or Shift Control Enter on PC. And that's going to fill in all these values. Right? So 400 values. It fills them in just like that. Right? So rather than us having to do each of these individually, it takes all that in for us. Right? So pretty happy about that. Now, of course, a natural question may be, how do we know that what we did was correct, right? So how do we know that, for instance, this actually is Apple's variance? And so if we were to do the variance calculation, now you don't have to show this or anything, but just to kind of show you that we could verify it. So again, so each of these is a covariance, and so the covariance of Apple with Apple, so the covariance here is the variance. So we saw that in chapter 6, or we see that in chapter 6. So so basically, this is the variance of Apple. So if I calculate the variance of Apple, so again the sample version, then in fact I get the same number. So Excel's not showing as many decimal places there, but it's the same number. And so it does look like things are working thus far. So that's going to be our big input for the portfolio variance. So now we have all the variances, we have all the covariances calculated, we have all the average returns calculated. So our last step, before we can start doing those portfolio values, we need the weights. So we need some weights for our stocks. Now the good news is that for the time being, we don't really need any particular weights. We just need to set up some dummy weights so that then we can get the calculation going, and then again we'll optimize later. We'll figure out what the optimal weights are later. Right, and so what I say normally is to just plug in 100% in your first stock and say 0 in everything else. And the reason being is that then we can go back and kind of verify that if I have 100% in Apple, then that means the portfolio values should just be these two. Right? So if I have 100% in Apple, then the return, then really I don't really even have a portfolio. I just have Apple, so its average return should be that, its variance should be that, and that way I can kind of confirm things. All right, so it's kind of the cheater way to make sure that I did things right. Anyway, so I have that set up. Now the last thing that I want to do here is to just throw in here, I want to throw in a cell over at the end here somewhere and say the sum of these is equal to 1. Now I'm actually going to leave a space here, the reason being that way whenever I try to select the weights later, it won't catch up or it won't get caught up in it. It doesn't matter, you can put it right beside it, you can put it way out in no man's land, whatever. But anyway, so the point being that the weights add up to 1. All right, so the sum of the weights add up to 1. And this is basically going to be a cheater way to do things later. It's going to be important whenever Excel is changing these weights that I tell it these have to add up to 1. You know, so regardless of whether you think you found a better value or not, the weights have to add up to 100%. Because Excel doesn't know what it's changing here. It doesn't know what all these numbers mean. It's just trying to mathematically find an optimal value. So the sum here is how we kind of check that or hold it to reasonable things. Anyway, so now we have everything we need, so we can set up our portfolio values. All right, so our return, our variance, our standard deviation, and so the first thing will be our return. That's the easiest one. Is that our return, well, the return's just the weighted average of the average returns, or the weighted average of the individual stock returns. So I just need to take the weight in Apple times the return in Apple plus the weight in Disney times the return in Disney, and so on and so forth. Now again, this is a case where we kind of do things with a formula. Excel would like to do things with matrices, so we could do this in matrix form, but that would be a bit awkward to do. The good news is that Excel gives us again, kind of a cheater function to do something, which is the sum product. Right, so the sum product is going to do that exact calculation we want. It's going to take those, line them up, and say, okay, first one times first one plus second one times second one. And so that way we don't have to do the matrix stuff. Right, so sum product of the weights. And now again, so if you put your sum right beside here, make sure you didn't select it here. So you just want the actual weights. Then I'll say comma, and then I'll go up here and select the average returns. So actually my first array I canceled out. So now I select the returns, and so then we just have to hit enter. Like I said, so the sum product is kind of a cheater function in that it's doing a matrix calculation, or it's doing a matrix E calculation, but it doesn't require you to do the same kind of verification, because it's always going to give you one cell out. Okay, so we have that. We could also do our variance. So the variance is the tricky one of the bunch. So we're doing that big kind of 3 matrix multiplication here. So we're going to take the weights times the covariance matrix times the weights again, but the weights are going to be flipped up as a vector, or as a column this time. So when we go to do this, unfortunately, what we see is that the mmult can only take 2 at a time, so it can't do a 3-step process or a 3-matrix process like that. So we're going to have to actually use a nested mmult function. So I'm going to do an mmult inside of the mmult. Right? So I'm going to tell it to multiply these 2 matrices, and that's going to be the input for the other one. Right? So you can really do that in either order. So you could do the mmult first or second, doesn't matter, but you just have to make sure that you have it in there somewhere. So for me, I'm just going to go ahead and get it out of the way. So my weights are first, So I'd select the weights, and then I'm going to multiply those by the covariance matrix. So I'd select those, close my parentheses there. All right, so I'm taking the weights, multiplying them by the covariance matrix, and that's going to be my first input then for the bigger MULT here. And then I want to input the weights transposed. Right, so I want to take the weights and put them into a column. So again, we can use that transpose function to do that. So I'll select them again. So I have an MULT of the result here times the transpose of these functions. Right, so I'm taking. So Excel's going to look at this. It's going to say, okay, I take the weights times the covariance matrix, and then that's going to be my first matrix, and then I multiply that by by this row flipped up as a column. Right, and so it's going to take that. It's going to do it. But if we hit enter here, we're actually still going to get an error. Right, so we're still going to get a value error. And again, it comes back to the fact that we're using these matrix functions. Right, so despite the fact that in this case the portfolio variance is just a single number, it's still going to give us an error. And so we still have to go Command Shift Enter or Control Shift Enter to get our value out. Now at this point it's worth checking. So these two numbers, if I scroll up here, are in fact my variance for Apple, my average return for Apple. So it does look like my calculations are set up properly, right? And so whatever your first value is there, or whatever value you set to have a weight of 1, just kind of confirm at this point that the numbers worked. Okay, so that's the first two. The last one's the standard deviation. Well, that's a lot easier because we can just take a square root. Right, so Excel has a built-in square root function, SQRT here, and so we just take the square root of the variance, and we're done with standard deviation. And so now we've got the basic values that we needed. So something that may come up here, or you may have had the thought before, is that these numbers all look really small. So it seems strange that we're dealing with 0.35% or 0.03, so 3.3% as a standard deviation. These seem like really tiny numbers. But you have to remember that we're dealing in weeks here. So these are actually weekly returns, weekly standard deviations. So in fact, if you were to compound this, so just really quickly to say that raise this to the 52nd, that's actually going to be a 20.3% return. Right. So it looks like it's a really small number, and admittedly it is in isolation. But if you think about it over an annual period, it's actually a fairly large number. So anytime you're dealing with daily data, weekly data, even monthly data, you kind of run into that where you see kind of small numbers, but really that's okay. In fact, it would be a little strange if you had really big numbers. That would be something to kind of worry about. But in any event, so we have those. The last thing that we need is the portfolio Sharpe ratio, and that's going to require us to use Google now, because we're going to need the risk-free rate to be able to do it. So we need some risk-free rate to plug in here. Now again, this is a case where there are plenty of other ways you may want to get this data. You can actually get it from Yahoo, you can get it from NASDAQ, from Google, but we need data on treasury rates. So we're going to say that treasuries are risk-free, so we want to get data on whatever their rates are. So I'm just going to Google treasury rates. And so if you Google Treasury rates, Treasury yields, Treasury yield curve, daily Treasury, just about any combination, one of the first things that's going to come up is the daily Treasury yield curve rates, which is hosted by the Treasury. So they have just tons of data available here about what the yields are on different different Treasury securities, basically daily. So we look at this. So it's going to bring up the data for this month, and so we've got the 1 month T-bill, the 3 month, 6 month, a year, 2 year, 3 year, all the way up to 30 years. And so this is the current month, but certainly you can get data from basically any year back to 1990 here. So a really robust set of data. Now, what I want you to do is kind of using the data available from 2014 to today, or to when you're working on this, to come up with some kind of reasonable way to calculate this. Right. Now, that could be just take a simple average of one of the columns, so back to 2014. That could be, just taking a particular day. Maybe you take the one at the start, so maybe the 3 year at the start. Just anything that you could remotely justify, I'm going to be okay with. Right. The point is just to get something semi-realistic for this project. You guys in modeling, you'll do a very similar project. There, they'll probably care a lot more about you actually getting a rate that's more accurate. Here, we're just dealing with the mechanics. So for my purposes, I kind of looked at the 3 year and just trying to figure out kind of an average of it. So certainly I could have went through and downloaded the data here, or copied the data in, and done an average. So if you, to get a sense of it here quickly, it looks like about 1.5% or so for 2017. It's about 1% for 2016, 2015 on average. So you come out to somewhere around 1.2%. And again, so I'll take 1.2%. If there are certainly reasonable arguments to be made for using a 1 month, a 3 month, a year, a 3 year. So whatever version or whatever way you prefer is fine, as long as there's some way to justify it. Now, what I don't want to see would be using these really long-term rates out here. Right, those are not going to be realistic as a risk-free rate for such a short-term time horizon. Right, so we're looking at 1 month we're looking at 1 week intervals over a 3 year period. It doesn't make sense to be looking at a 30-year bond to get your risk-free rates. Right, so, but as far as whether you're looking at 1 month, 6 months, whatever, any of that's going to be fine. Right, as long as you can remotely think of a way to justify that, then you're fine. So anyway, so I'm going to use 1.2%. So now the other thing to note here is that if you think about this risk-free rate, then these are actually in annual terms. Right, so they're the yield on that particular day, but they are annual yields. They're not actually the yield for the day of the 4th. They are the yield on a 3 year Treasury as of that day. Right, so that's 1.2% for a year. So one thing I'm going to have to do then is convert that to a daily rate. So I'm actually going to have to do a root here. Right, so raise that to the 1/52, or if you prefer kind of the accounting method, 1/50. Right, so just to try to de-annualize it. Right, so convert it back to a weekly rate. So that gets us a really small number. Right? That gets us a really small number in the scheme of things, which makes sense. Right? So if you think about a 1.3% rate, that doesn't take very much over the course of 52 weeks. Right? That doesn't take very much each week to get there. So it makes sense that it's a really small number. From there, our risk-free rate, or excuse me, our Sharpe ratio, we take our return, we subtract out the risk-free rate, and then we divide by the standard deviation. All right, so the actual calculation of the Sharpe ratio is fairly easy for us. So given a 1% of standard deviation, we get about 10 basis points for that. Using Apple here. So now we're ready to kind of move on. We're ready to really get to the meat of it. Right. So now the next part that I'm going to ask you to do is really something that we wouldn't necessarily need to do to optimize the portfolio. So if we were just optimizing the portfolio, we're almost done. But for this project, I want you to actually do create a minimum variance frontier. Call it an efficient frontier, because you can, a lot of times people interchange those terms. But we're going to take some returns and just kind of generate some returns that you could have. And then figure out efficient portfolios to go with those. So we're going to do that. I want you to do 11 of them. So you're going to start with your lowest return. So the minimum return that you had, and then I want you to work your way up in 10% increments. So you'd have 100% times the lowest return, 90% times the lowest return, plus 10% times the highest return, and so on until you get to 100% in the highest return. Right, and so that way you get an efficient frontier, so you kind of get that parabola shape for a graph, because ultimately I want you to graph these. And so our efficient frontier, I want to generate the returns. So kind of going through here, right, then so the weight, so a couple things here. So I actually want to give myself a little bit more room here. So my minimum return and my maximum return. Right, so I want my lowest returning stock and my highest returning stock. So the good news is that Excel has functions for both of those, so just the min and the max. So for the minimum return, I use the min. So I'm just going to select the average returns. And so out of this, I'm going to get Exxon's return here, so the negative 0.00117. And then for the max return, again, so max, and I'll just select the average returns. So I'm going to get Visa's return out of this, so 0.00453 or 454. So those are my highest returns, those are my lowest returns. So I'm going to say then, so I'm going to just set up a column here. Now you can do this all in kind of one go. That's fine. It just is a little trickier to do, or a little trickier to keep track of, so I'll just do it this way so it's a little easier to follow. So I'm going to set up the set of weights. So for each of these portfolios, I'm going to have 100% in the lowest, 90% in the lowest, 80% in the lowest, so and same thing in the high, or reverse in the high, so I'll have 0, 10%, 20%, etc. And so then my returns, so I'd have the weight in the lowest times the return, plus the weight in the highest times its return. And so that works for here. Now, I can't just drag this one down, or I can't just click this one down, because Excel's going to try to adjust these references, and it's going to move those cells down. So what I'm going to need to do is to go in here, and for the minimum return and maximum return, I need to $sign those. So you can either hit F4 to automatically do it, or you can put in the $signs yourself. Right, so there, hit F4, so it added the $signs. Or I can just type them in myself, so a $sign before the B and before the 358. Now if I click and it goes through, then now it moves these references down, so it moves the weights down, but it leaves those returns set. So that was what we wanted. Okay, so now I've got those returns. And so now I'm going to make a table using those. So I'm going to have the return, and then I want the standard deviation and the Sharpe ratio, as well as the weights of the stocks. So what I'm going to ask you to do is to figure out the minimum variance portfolio that goes with each of these returns. And then I want you to make a record of the standard deviation and the Sharpe ratio, as well as the weights that you use to get that portfolio. So I just copied my values down, copy and pasted values down here, so I have the returns kind of beside it here. And then I'm going to just fill these in. Now at this point, you're going to need to use Solver. So Solver is an add-in. Now before I said that I didn't want you to use add-ins, the difference here being that Solver is an add-in that's built into Excel. So as long as you're using a relatively modern version of Excel, or almost any Windows version, then you'll have Solver available. So there's not really as big of an issue with trying to come up with it, or having no access to it. So that's why we're going to use it here. Now, it is built in, but it's not enabled to start with. So for a Mac, you're going to need to go to Tools. So if you've used it before, it'll be on the Data ribbon. So it's the question mark over on the end here on mine. If you haven't used it, you'll need to go to Tools, down at the bottom, Excel add-ins, and then you'll need to click on the checkbox for the Solver add-in, and then you'll hit OK. And then Excel will work for a minute or two, and then Solver will show up. For Windows, you'll go over here to, I believe, the Excel tab on the ribbons, go down to Options, go down to so then a box will pop up. You'll go down to add-ins, and then you'll say there will be a box near the bottom that says Manage Add-ins, and that will bring up the checkbox so you can check Solver and hit OK. But in any event, once we get Solver going, then we can use it. Let me reset Solver here so we don't. Okay. Okay, sorry about that. So Solver's acting a little strange here. Let me turn it off and turn it back on here. There we go. Okay, so we bring up Solver, and so this is pretty well how it looks on both versions. So you have your objective, what you want to do to it, what cells you want to change, any constraints that you have, and then a couple other options here. So first thing is our objective is a little bit counterintuitive, but here we want to minimize our variance or minimize our standard deviation. So our objective is going to be the portfolio standard deviation, so up here where we have calculated it. So we want Excel to be able to minimize it. Well, we need somewhere where it's actually doing something. So we're going to select the one that we set up earlier. Again, we're going to say minimize that. And we're going to say to minimize it by changing the weights. All right, so here we're going to change our weights. And now we're going to have a couple constraints. So the first one is that those constraints that we're changing need to be equal to 1. Right? Or the sum of those needs to be equal to 1. So we're going to say that the sum, this cell over here that we made before, has to equal 1. Then we're going to say add, because we have a second constraint. The other thing is, I want to say that the portfolio return has to equal the return over here. So the portfolio return has to equal the return in the table here. And so at that point, we're kind of set up with the main stuff. Going from there, then the two other things. The solving method, I would say don't change. Sometimes for more advanced purposes, you may want to change it. For our purposes, there's no real reason to do that. You'll just mess something up, to be honest. So if you don't know that there's reason you need to change, I strongly encourage you to just leave it. The other thing is this checkbox that says make unconstrained variables non-negative. So that one has actually a very concrete purpose for us, but we're going to leave it checked here. So in particular, what that does is controls whether or not you're allowed to short. Now again, Excel doesn't understand that. Excel just sees a bunch of numbers, but that's ultimately how it translates for us. So that's going to mean that whenever Excel calculates these weights, if we leave that box checked, then they're going to have to be 0 or have to be positive. Whereas if we uncheck it, then they can be negative, and we have negative weights when we short. So, you know, arguably it'd be more realistic to uncheck it and let us have negative weights, but that goes back to the problem is that Excel doesn't actually know what it's doing. So Excel will then find the kind of mathematically optimal solution, which may be to short 100 billion% of one stock and put 500 million% in another stock. Right? So you get some really unrealistic answers. So we could fix that by adding in a bunch more constraints to make things more realistic. But for our purposes here, we're just going to leave it checked and say there is no shorting. And that will really simplify our lives. Okay, so now we're ready to go. We're ready to hit solve here. And so you'll notice that these numbers are going to change a little bit. So solver found a solution. All constraints are satisfied. So we'll hit OK here. And so what we see come out of this is that 100% is in Exxon. So I'm just going to copy and paste the weights down here, and then the standard deviation and the Sharpe ratio, I'm actually going to have to paste special. So you will need to paste those as values, because if you just paste the formula, then either the formula is going to line up and try to reference something else, or if you do get the formula kind of translated properly, then whenever you run solver again, it's going to change. Right? So you need these to be values. You need these to not be calculating anymore. So I'm going to do Command Control V, I believe it's Control Alt V on Windows, and do values for my standard deviation, and same thing for the Sharpe ratio. Alternatively, if you're not getting the keyboard shortcut to work, you can go to Paste on the Home ribbon and select Values there. Right? So either way works. But so at this point, we're going to kind of repeat that process a few times. So that was one. I want to keep doing that for each of those 11 portfolios. Right, now the only change that we have to make is that constraint on the return. So the constraint where the return had to equal this return, we're just going to change that to the next one. So you either select the next cell or just change it to 375 here, or whatever cell it happens to be for you. And then I'll hit solve. All right, so it'll take a second, especially on a Mac. Sometimes Solver takes quite a while to run. But now we see the numbers are a little bit different. And then I just want to paste those in. Again, so standard deviation and Sharpe ratio, I have to paste special. The weights don't matter. So the weights, there's no formula there. So I can either paste special or paste normally. It doesn't change anything. But again, here I'm just going to go down the table. So I'm going to keep finding a different portfolio that matches each of those returns. And you can kind of see that the numbers are changing here. So the standard deviations are getting lower at the moment. We have a lot more stocks involved now. So that first one was just Exxon. Now I've got quite a few in there. So this is where we see kind of one of the differences with our minimum variance portfolio, or our minimum variance frontier versus the efficient frontier. What we're going to see is that as we get higher, as our returns increase here, we're going to hit a point where the standard deviation actually starts going back up. Right? We're not quite there yet, but you can see we went down really quickly and now it's kind of slowing. Eventually they'll start going back up. Right? So strictly speaking, what we're making here is not the efficient frontier, it's the minimum variance frontier. Right? And ultimately, for optimizing, none of this matters anyway, because we can just go straight to the optimal portfolio. But what I want you to get a sense of is kind of the process of elimination in terms of kind of getting from just a bunch of random assets to ultimately what Solver has kind of done in the background for us, or what all the math has done in the background for us. So here you can see we started to go back up. And so as we kind of see in Chapter 6, or as we alluded to in Chapter 6, those portfolios with these low returns actually end up being kind of knocked out by some of the higher return portfolios. Right, so they had the minimum variance for their return, but I can get another portfolio that has the minimum variance for its return that's the same variance but for a higher return. Right. So kind of, for example, here we have pretty similar variances here, but a much higher return for the second one. So you know, ultimately, all this stuff that's happening here as we run through these is just a way of kind of seeing how all the bloodiness, all the you know, the making of the sausage that a lot of times we may miss otherwise. Now, as we kind of get through here, and again, I'm just doing the same thing. I'm still just changing this one constraint. As we get through here and get towards the end of this, then one thing that may happen, so say that you had a return formula that you had typed in wrong, or Solver just has a bad day or something. If Solver has an error, then sometimes what happens is that it will get kind of stuck on that error. So it changes the values. It eventually figures out it's not going to get an answer, and then it just kind of gives up with the values like they were. And so when that happens, then sometimes you find that Solver won't really come off of those values where it gave up. It's almost like it has a panic attack or something. You know, it kind of freaks out and it just won't change. You know, so even if you give it a number that you know works, then it just keeps coming back to well, there's a problem. You know, I can't figure it out. There's a problem, and so if that happens, what I recommend is to just reset your weights. So go back to like 100% in one stock or equal weights, and let it kind of go from there. That way it kind of clears that bad value out. So we'll look at an example of that in just a second. Another thing that happens that's not a big deal is you'll see sometimes where Solver doesn't quite round properly. So this portfolio should be just 100% in Visa, but it ends up with some tiny portion or some tiny short with McDonald's here, because basically Solver's just kind of guessing a bunch of random numbers, and eventually it gets a solution that it looks like with rounding works, so it just kind of stops there, even though strictly speaking it's not really accurate, right? But it's accurate to 6 or 7 decimal places, so close enough. So that's not really going to be an issue for us. It's just something that looks a little strange, so don't worry if you see that. Okay, so we have our table now. Like I said, I want to do one more just to show a problem here. So say that I'd had a return here that was too high. So I had a return of 0.01. So something that I didn't have there. So if I solve, I'm not going to be able to find anything. Right? So it's not a feasible solution. Let's say then that I switch back, right? Then it's kind of a crapshoot. So sometimes it'll work if you give it another constraint, but other times it may not. So just checking here. So in this case it did work. So in this case it did find a solution. But say that it didn't. Right, so say that we were still kind of stuck on that old one, then what I would recommend is to go through and just kind of reset your weights. So say Apple equals 1, everything else equals 0, because we did that before, we know that one works. Right, and so that way you get back to a state where Solver can kind of calm down and work. If that doesn't work, so if there's a bigger problem with Solver, then do reset all. Right? So that will totally clear Solver out, and that way, you know, any kind of weird problems that it may have in its memory or anything get fixed. Right? So now you can see it just basically cleared all that stuff out. So all our constraints and whatnot are gone. Right? So try those whenever you have any issues. Okay, now at this point, we've got almost everything we need. Right, the only thing we have left is just our optimal portfolio. Right, so now we're going to do Solver one more time, but it's going to look a bit different. So now we're actually going to be maximizing our Sharpe ratio. So we want the portfolio Sharpe ratio, we want to maximize it. So before we were minimizing standard deviation, now we're maximizing variance, or excuse me, we're maximizing the Sharpe ratio. We're going to be changing the weights, so that part's still the same. So we're still changing the weights. And then this problem is actually going to be a little bit simpler, because now the only constraint that we have is that the sum of those weights needs to add up to 1. So one of our constraints before, we don't have any constraint on the return or on the standard deviation. So we're only interested in what's the maximum Sharpe ratio. So what's the biggest I can make this number. Again, we'll leave the unconstrained variables non-negative so we can't short. We'll leave the solving method alone. So we are maximizing the Sharpe ratio given that our weights are add up to 1. So I do that, I get a solution. Hit OK. So again, just kind of copy and paste the values down here. So now you also need to make sure to get the return. So there's kind of one extra value to get. And then our weights. So in my case, maybe not the most interesting optimal portfolio because I end up putting half of it in Visa and nearly 45% in McDonald's. But point being, so that's the portfolio with the highest Sharpe ratio, and we can see here, kind of looking back, that Sharpe ratio is higher than the rest of these. Right, so it is a bit higher than any of the other values. And so now then we're ready to do the last step. Right, so we've done our minimum variance portfolio, or our minimum variance frontier, or what we call our efficient frontier. Right, we've optimized our portfolio. Now we want to graph it. So now we want to do the kind of visualization here to kind of tie all this together. Right, so what all we were doing means, or what all of it looks like. So what I would recommend is to make kind of two separate columns here. So I would take the returns and the standard deviation. So whenever you graph things in Excel, certainly you can adjust the data yourself, but it's always easier to kind of get the data the way that it needs to be first. And so in this case, Excel, whenever it sees two columns side by side, is going to assume that whatever's on the left is the X variable, whatever's on the right is the Y variable. But whenever we graph things in finance, we tend to graph things with the risk as the X-axis and the return as the Y-axis. So that's our idea. Ultimately, with asset pricing, is that the risk you're taking is what you're getting compensated for, is what's driving your return. Right? So we want the standard deviation to be the X-axis. So it's just easier if I go ahead and put it on the left-hand side. So we're going to have that. We're also going to have our capital allocation line, or CAL, that's going to be made up by our optimal portfolio. Well, we actually need another point there, right? So standard deviation, okay, return, yeah. Well, we need something else. Well, remember, we picked that line out of all these potential efficient portfolios using that risk-free asset, right? So it was the one that had the greatest slope from that risk-free asset. So we not only have the standard deviation in return of the efficient portfolio, of the optimal portfolio, we also have the standard deviation in return of the T-bill, or the Treasury security. So we have its return, and we're going to assume that its standard deviation is 0. And so that's all we need there. Now, what I'm going to do, just to make our line look a little bit better, is to add in a third point. So whatever our highest standard deviation over here is. So just the maximum of our standard deviations over there, which it turns out is this first one. I want to add another point so that the capital allocation line keeps going. So more like what we look at in class, it'll keep going past the optimal portfolio. Now, if I do that, well, here then, the return on this, so assuming that we are on the capital allocation line, the return would be the risk-free return plus the Sharpe ratio times the standard deviation. So kind of a point slope line there, that the slope of the line is the Sharpe ratio, the y-intercept is the t-bill. So I just have to go up the line to figure out what the return would be. And again, so this is just kind of a hypothetical point here, but that way our line doesn't just end. Because otherwise Excel's just going to draw the line here, and our capital allocation line would just kind of die wherever it touches the efficient frontier, which looks a little weird. Okay, but now we have everything we need to graph it. So I'm just going to highlight the minimum variance frontier over here, go to Insert, and I want to do a scatter plot. So I would say either do one of the smooth lines. So do a scatter plot either with smooth lines and markers for each point, or smooth lines with no markers, whichever you prefer. But that's going to get us then this graph, which I'll move over a little bit. Now I'm going to change the layout just so we get a little more information. So I'll change it to where we have our legend over here. All right, so this is our portfolio optimization project. So again, so on the y-axis we have our returns. On the x-axis we have our standard deviation. Now, what I want to do at this point is to, well, first I'll rename the data. So if I right-click here and say Select Data, right? So right-click or two-finger click for Mac. I'm just going to change the name on this series. So this part will look a little bit different depending on whether you're on a Mac or PC. So anyway, so now it says minimum variance frontier. So now we can be a little more accurate, a little more formal here. So this will look a little bit different depending on whether you're Mac or PC. PC, you're gonna have to say add series. So you'll have a series of almost like folder tabs or something to do add series to. For Mac, you're gonna hit the little plus sign here at the bottom. And now series 2, I'm going to name it capital allocation line here. And then our X values are going to be the standard deviation column. So those three. And then the Y values will be the return column. And you may have to hit the little cell button here to get out to be able to select those like I did there. And so at that point, you add that, and then we get something that looks similar to what we've done in class. Now, what you'll notice and what you can kind of tell with mine here, my minimum variance frontier looks kind of lumpy, right? So it has kind of a bump here and a kind of less than curved part down here. The reason that happens is because we're only doing a limited number of points. Basically, Excel's trying to kind of smooth out the curve, but I didn't give it enough information to really be able to do a good job. If you add in some more portfolios, so say about 20 or 30, then you get a nice smooth curve. So that's something that you can do. Just for our purposes, I don't think it's really worth it to force you to do that. So so for our purposes, it's perfectly fine if yours has a little bit of wobble to it. It still hopefully gets the point across. But at this point, you're done. So at this point, we have our portfolio. We have our optimization. So we had all these portfolios that we couldn't really decide between. We added in this risk-free asset, And then because of that, we can figure out that that one has the greatest slope, right? So that one's our optimal portfolio, right? Wherever it touches in there. And so, again, we didn't necessarily need to do the efficient frontier to get there. We could have just went straight to the optimization portion. But my hope is that this helps you kind of complete the picture in terms of now we've kind of seen all the way through, going from just getting the data to ultimately being able to produce and say, well, yeah, so this is my set of minimum variance portfolios. This is my optimal portfolio. So we have kind of the whole spectrum. So my hope is that this will help kind of complete the will help you kind of help drill that in a little bit better. So with that in mind, I hope that you enjoy the project. I hope that it does help you. I hope that you're enjoying the class, and I'll see you in class. So have a good day.